Hey guys, this is Uncle Dan, and I'm answering a question that came up from Friday around Tesla. What is a put credit spread, and what happened to my trade on Friday night after the close? So, what is a put credit spread? It's basically when you sell one put, which is near the money, and then you buy another put further away from the current price to protect your risk to the downside. It's actually a bullish trade. Think of it like this. If you were to sell a naked put, that's bullish, right? If you sell a naked put, that means you sell it first to open, and then you hope the stock goes up and the value of the put goes down, and then you buy it back to close the position. So you sell it first and then you buy it back. Now here's the problem if you sell a naked put. What if the stock plunges? And that's what happened with Tesla after the close on Friday. To protect yourself from the stock plunging and going past your strike price and having unlimited losses, you buy another put for less money, and then your risk is the difference between the two strikes. Now I have a video on a put credit spread. Take a look at my video on what is a put spread or what is a put. Okay, and that will give you the basics of what it is. Now I want to talk to you about a more advanced issue, which is what happens on expiry if the stock does something unexpected. If you noticed last Friday, Tesla closed right here around 420. The premiums were exceptionally high on the close. I've never seen the premiums this high before. At expiry, the at the money 420, the calls and the puts were both trading for over $5 with no time left. I've never seen that. I have been able to buy calls at the money for only 18 cents before. And today I'd have to pay $550 for the same at the money option with 1 minute to go. So the market was anticipating a huge move on the back of the S&P announcement on stocks to be included in the index. Now, when the premiums are high, we don't know whether people are bullish or bearish, but they're expecting a move, and that's what you're going to get. So this is what happened: is S&P announced at 5:15 Tesla would not be in there. Okay, and so you can see at 5:14 if somebody bid up Tesla to 423, they were adamant that that stock was going to be included. So 1 minute before the announcement, they had already started buying it. It's so funny. And then here comes the announcement: Tesla's not in it. So boom, immediately it drops $5. All right, and then it drops again and again. Now this is 5:15. Okay, now you have till 5:30 to tell the clearinghouse whether you want to exercise your option if you own it. Now on a put credit spread, the closest strike, you don't own it, someone else owns it. So there's nothing you can do with it. When the stock closed at 420, let's just say, for example, you had a 410, 405 put spread. Well, both of them expired out of the money. So technically, they're not worth anything. Okay, but what happens after the close and you go here, it's neither one are going to be assigned because the stock market's closed, but the stock continues to trade. Now at 5:15, S&P said Tesla's not in. All of a sudden, within 2 minutes, we're below the 410. Okay, so if you had shorted a 410 put, which was worth 0 at the close, and the stock drops to 390, 410 put is worth 20 bucks, which equals times 100 shares $2,000. So your put that was worth nothing is now worth 2,000. Now you would say, okay, well that's why I bought a 405 put to protect my position. Well, guess what? Because the market closed at 4, and because you have to inform your broker by 5 p.m. so that they can have enough time to contact the clearinghouse, everything closes at 5:30, which is right here. Okay, so right here the market closed. It was 398. You're not able to call your broker if you're trading with Robinhood and say, hey, I'd like to quickly, hey, I need to exercise my right to sell Tesla at 405 because I just bought it at 410 because someone's going to assign their stock to me. You don't have enough time to do that with Robinhood. So you're stuck. So what happens is the market maker very quietly waits until right at 5:30 and assigns you shares at 410. You don't have time to do anything about your 405. So now you're long stock at 410. The 405 put that was supposed to protect you it's not any good to you because you're not even able to pick up the phone and call Robinhood and tell them that you want to exercise your right on that 405 put. So you're stuck. You now own it at 410 and the stock is trading at 390. You're out $2,000. God forbid you have more than one contract on, you'll be wiped out. So what's the lesson here is, A, if you're going to do credit spreads on high price stocks, you take them off before they close at 4 p.m., even though they're worth zero. If you go back and look at my video on Nikola, you can see where the stock was trading at one price and then plunged $10 30 minutes later. All right, so if you don't understand how assignment works, and if you aren't able to pick up the phone and call your broker and to instruct the clearinghouse to do whatever you want to do with your options that you're long, you should not be trading these credit spreads, and you definitely don't leave them on. You always take them off. Now, I'm a professional trader, and I always take them off. But that's what's happened with Tesla. We saw it with Nikola, all right, and we have a video you can watch to see that. In this video, we're going to walk you through what a put credit spread is, okay? This is an option contract, which is between two people. You have both a short put that's near the money and a long put that's further away from the money, okay? They call it a credit spread because you actually get paid money up front when you do this trade. Okay, so this is nice in that you're not spending money, you're actually getting a credit. Now it's an option contract, which means it gives you the right to both buy and sell 100 shares of stock, but at different prices. Okay, they also call this a put vertical spread. They also call it buying a bull put option spread. So it's on 100 shares. And with Tesla as our example, we're going to sell the 410 strike and we're going to buy the 405 strike. And we're going to do it with 1 day of expiry. This is the option from last Friday in Tesla, okay, just before the S&P 500 announcement came out. So the option contract has an expiry date, and for this particular option contract, it's a 1 day option. So the first thing we do is we sell a 410 put, and we get a credit for selling that. We're going to sell it as an open trade, okay? Then we're going to buy a put. We're going to buy the 405 put. Now that buying the put gives us the right to sell 100 shares at the strike price of 405. Now the credit we're going to get between these two strikes is 75 cents. Okay, that's the difference in the net amount that we collect on Tesla for this 410-405 put spread. Now you may ask me, why don't you just buy stock? Why do you got to do some kind of complicated put spread? Well, when we do this put credit spread, we get paid 75 cents up front as a credit goes into our bank account. If we want to buy 100 shares of Tesla, we need to spend $42,500. So I'd rather collect $75 than pay $42,500 just to put on a bullish trade on Tesla. Okay? But there's also the situation of, okay, but what happens when I put the trade on? How do I get out of it? Because you always want to close your credit spreads before they expire. Well, it's just like buying and selling stock. There's market makers that will quote you a bid-ask price on that spread. So before expiry, you always want to get out of your credit spread, okay? So in our example, stock's at 420 and we own a 410, 405 credit put spread. Whoa! But what can go wrong in these credit spreads is you might get assigned stock. Now, if you get assigned stock at 410, which is your short strike, that means you're going to owe $41,000. Okay, that's if you didn't sell your spread before the market closed at 4 p.m. Okay, now you own the 405 strike, so by right you should be able to get out. But how do you get out of your position after 4 p.m. on expiry day if you weren't smart enough to unwind your position? You got a big problem because you're going to get assigned at 410 and you're going to own shares at 410, but how are you going to exercise your 405 put, which had closed at 0? See, if Tesla plunges down to 390, you need to get out of that position. You need to call your broker and tell them you want to exercise that before 5 p.m. But if you're trading on Robinhood, they're not going to take your call. You're stuck, which means your 405 put that you bought, you're not going to be able to exercise it because the market closed at 420. So you're in big trouble now. So if Tesla closes at 420 and plunges to 390 at 5:15 p.m., you're in big trouble.
And that's what happens to some people. You got to get on the phone, call your broker, and tell them, I want to exercise my 405 put because I've been assigned stock at 410. After 4 p.m. on expiry day, at 5:30 p.m., game is over. And most brokers won't take a call after 5 p.m. to do that.
So now let's assume you did get out before expiry at 4 p.m. on Friday with Tesla. This is what your risk profile would look like. If the stock had plunged down to 390, okay, your 405 put would have been exercised by the broker automatically. You wouldn't have had to do anything. Okay, so if it had plunged at 390, say at 4 p.m. instead of 5:15 p.m., then your loss would have been limited down at 405. Now your maximum profit was 75 cents. So if it stayed at 420, you would have made a 75-cent profit there, okay? But your losses would have been limited because below 405, you would have lost $4.25, but that would have been it, even if it went down to 390. So I hope that makes sense. Good luck.